I do think it's clear that that policy is restrictive. I think it's unlikely that the next policy rate move will be a hike.
Jay Powell there outlining the path for Fed policy after keeping rates on hold. Welcome to the show. We're half an hour away from the opening bell, Hong Kong. You're watching, of course, the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: Asian stocks cautious while treasuries give up some gains after that rally overnight, with Powell downplaying the possibility of rate hikes.
We're looking at the Japanese currency, very much in focus after the top currency official refusing to say if they stepped into this market after today's sharp moves in the Japanese yen.
And Chinese property stocks in focus on fresh measures to support the market, including a ban on new land sales for regions with huge stockpiles. It's a pretty mixed picture out there in terms of what we saw after the Fed. Yes, Jay Powell was expected to be hawkish. He didn't quite get there. He did acknowledge there's a lack of progress to heading to that 2% inflation goal, which was added to that statement. But then again, he also reiterated that rate cuts are still on the table. They talked about, that tail risk of a rate hike possibly reduced here right now, as he talked about unlikely the next move from the Fed could be a rate hike. So certainly that helped. And then an earlier announcement on the pace of reduction of QT, that certainly might lift risk assets here today as well. You're not quite seeing that sort of follow through. In fact, we saw one of the biggest cross asset surges intraday in the U.S., but it didn't last long, right? Perhaps because the market is still wondering the timing of these rate cuts. And is this really a Fed that is willing to cut rates in November during an election year? That certainly is something that the market is contending with. You take a look at where yields are right now. That 2-year initially did see a drop about 7 basis points or so. We're still around well below that 5% level at 4.96. The 10-year is not doing a whole lot at 4.62. But Treasury yields did drop but moderate. So did the dollar as well. We're still seeing some weakness when it comes to greenback here this morning. And perhaps that's why you're seeing a little bit of movement, that massive move once again. I think we went from 157 to 153 at one point in just about 30 minutes for dollar yen. We're hovering around that 155 level right now. Dave mentioned those conduct comments saying, look, I'm not going to comment whether we intervene or not. But there is speculation, once again, that perhaps we did see intervention for a second day. So watching if we continue to see that strength pull through. You take a look when it comes to Brent. Obviously, that weakness in oil is what we're watching out for. There's been inventories that have been swelling up when it comes to the U.S. as well. That's what's driving Brent to around $83 right now. WTI actually broke below that $80 level as well. And we're watching very closely what happens to U.S. futures. It's rare to see a move like this. So, a gain about 0.4% in the Asia session. So we'll see what's driving that overall. You take a look at what's going on in China here. Of course, Hong Kong is coming back from that holiday. China remains closed, though, mind you. So we'll see if, the lack of southbound flows to Hong Kong, is that going to impact this market in any way here as well? You talk about what's been going on. You look at foreign investors piling into this market. We basically saw them boosting the holdings of Chinese stocks for a third straight month. That's the longest run that we've seen in terms of monthly net purchases, Dave, in more than a year or so. Mind you, though, in April, you exclude just one record day of buying and everything else was sort of negative in terms of flows. But foreign investors are certainly looking very closely at this market here right now. That Politburo meeting that we got just a few nights ago, they're talking more about reforms. They're talking more about growth measures. Some of these more targeted measures in the property market, especially when it comes to inventory reduction. That certainly seems to be a key focus now.
Yeah, absolutely. And in fact, right now the conversation then shifts to, will there be a budget allocation for that specific exercise, if indeed, of course, that's the path that China goes? As Yvonne is pointing out, the other question, too, as you look at these markets, we're 7 days up when the Hang Seng Index will reopen today. Where will that money come from now that, at least for the next today and tomorrow, the Stock Connects, the program is shut because of the holiday, of course, in mainland China. Still, a couple of sectors to watch. Bottom of your screens, a big drop in oil overnight. GDP numbers coming out of Hong Kong later today as well. It takes us straight back into the macro stories. We talked about the Fed. We didn't get that boost in the U.S. dollar overnight that might have actually led to, and this is sort of hindsight, when you look at Dixie, for example, we were flirting with the highest level here so far this year. Dollar yen Who knows if they did? They're saying no comment for now. And I guess in some ways it's hard to imagine someone waking up with that much muscle and deciding the yen's too cheap right now. Dollar yen right now, which is interesting because a 3 yen move, we're now actually back to 156. That's not the chart we're looking at, by the way. We'll get to that in a moment. But yeah, why don't we go back to the Fed while we correct that?
Well, it's interesting, right? Because you mentioned that 3% gain on the yen. I think it's the largest intraday gain we've seen since December of 2023. Most of the traders that you talk to say, if it's not intervention, I don't see anything else that could have led to such a big, dramatic price swing, right? But I think people are saying, unless we see some sort of change in BOJ policy that actually, supports this intervention, these gains are not really going to last. Yeah, we keep to just I think it's to stabilize things between, and lots of people are talking about, is it 152 to 155? Is it 155 to 160, where they want to stabilize things until the Fed eventually cuts rates? So the dip overnight in this morning took us to 153.04. And just like that, we're back to 156. Watch us very closely. Yep. All right, back to the Fed now. And we heard from Chair Jay Powell, who talked about the need to keep those rates where they are.
I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer. I think it's unlikely that the next policy rate move will be a hike.
Nancy Davis joins us now, founder and CIO of Quadratic Capital Management. Nancy, hawkish statement, dovish press briefing. How did you read into the entire exercise overnight?
Well, Powell is definitely trying to sound balance, talking out of both sides of his, both sides, dovish and hawkish. But the reality is they're reducing the quantitative tightening, which is easing. Like less QE means easing. So overall, it was pretty dovish, especially given how strong the data has been in the U.S.
So you say we still need to be cautious about the current pricing, right? We've gone from 6 rate cuts to maybe now 1 or more. Why?
I think the Fed is easing with their balance sheet, not cutting rates right now, reducing the quantitative tightening band, especially when you consider the piece of the Fed's balance sheet that is the denominator of this equation is $7 trillion, right? That's the piece of the Fed's balance sheet that the New York Fed went out and bought in the open market. So reducing quantitative tightening is easing. It's just not the easing that the bond market was looking for at the beginning of the year with the rate cuts.
Okay, so is that another way of saying the Fed is having its cake and eating it too, Nancy?
Oh, the Fed is creating inflation is what's happening. There's so much money supply out there. The Silicon Valley Bank, the Fed implemented this, the BTSP program, the swap lines that literally just expired in March. And boom, we get a bank in Philadelphia already blowing up. And so I think the quantitative tightening easing or reducing it is going to happen in June, but it's just another way to push more and more liquidity. And so I think investors should really be positioning to actually own inflation protected bonds. You've already seen this reflation happen in commodity stocks and cyclical equities and other markets. But the rates market, the inflation markets are still incredibly complacent in the U.S. They've got a problem. Inflation is going to go back to 2%. And to me, that seems like a really great buying opportunity.
So I was looking at more on the QT side of things, right? Yeah. So they're starting in June, as you mentioned, from that cap of $60 billion to now $25 billion. Is that going to be a boon for risk assets in particular, Nancy, in some ways? Does that at least relieve some of the upward pressure on Treasury yields moving forward?
Well, mortgages are really the tricky one. So they've said they don't want to own mortgages. They're not reducing the quantitative tightening with the mortgages. And there's basically no cap on mortgages because when the mortgages expire, they're going to reinvest back into Treasuries. So I think it's really important for investors to look like when you have the Bloomberg Ag Index, for instance, which is a wonderful core fixed income index, but 25% of that is mortgages. And so I think you have to be really careful about spreads there. with the Fed kind of allowing QT to continue there and saying long term they don't want to own mortgages on the balance sheet.
So, Nancy, then you mentioned it's a great probably time to get into tips, for example. What about steepeners? Because that's burned a lot of investors in the past. And is it time to revisit that, or is there time still to wait until a clearer trigger for steepeners at this point?
Well, steepeners in the linear format, which is basically like buying one part of the curve and shorting the other, is really dangerous because the yield curve has been inverted longer than it ever has in our lifetime. It's been, inverted for the longest period ever in history in the financial markets. The question is, when will it normalize? Talking about Japan, if you pull up the 2s 10s curve on the JGB curve or the JPY swap curves, you'll see it's about positive 60. The US is exactly opposite. It's negative 63 in the 2s 10s SOFR curve right now. So having that normalize, becoming less negative in the US will eventually happen. But I think the tricky thing is doing it in a linear format. You could have a lot of pain. The curve's inverted about 30 basis points additional this year alone. So using options, fully funded options, I think is the way to go to play curve steepening, because then when it happens, you have that asymmetric payoff. But at least as it's continuing to invert, you know what you can lose.
Okay, you mentioned about these rate differentials between Japan and the U.S. I mean, the massive moves we're seeing in dollar yen here right now. I mean, if it's not intervention, what else could it be? Is one question. But then again, how do you trade around this sort of environment now?
Well, it's probably short covering. Being short the yen, long the dollar is a very, very popular kind of macro theme right now. And everybody is sort of waiting to see which central bank moves first, like whether it's the Fed cutting rates, which is, something today's commentary was more dovish than what a lot of people were worried about, because they sort of took the hike off the table. They are being dovish by reducing quantitative tightening. So I think we should expect more volatility in dollar yen, more volatility generally in any of these cross currencies, because FX is all about rate differentials. And it's really hard to pinpoint where to go, but I think it's a great time to be hedging, because generally volatility is not super expensive across asset classes. And regarding what your currency risk is, it's why not put on a hedge and not kind of put your future in the central banker's hands.
Nancy, let's book our gains post-Fed. Do you think that the bottom's in for Treasuries, and do you think Jay Powell, by not really biting any opportunity to sound hawkish overnight, do you think he's also cemented rate cuts? Maybe November, maybe December, doesn't matter. But has he done that for 2024?
Well, Powell has a great history of what he says, the opposite happens, right? And not trying to bully him at all. But, transitory, that was not right. Not even thinking about raising rates. Then we went into one of the biggest hiking cycles we've ever seen in our lifetime, with about five and a quarter in a 12-month period. So I think the thing we should all be, looking out for, and I think, Powell kind of cursed us tonight with it, is the making fun of stagflation. He's like, I don't believe in the stag or the flation. I think that should be really on investors' watch list now, because whatever Powell says won't happen does happen in the future. So sorry to be the Debbie Downer tonight, but I really just don't have a ton of trust in these academics who are, it almost feels like the Wizard of Oz, where they're pulling this lever. They have no idea what's going on.
All right. On that note, we're going to leave it there. Nancy Davis, thank you, founder and CIO of Quadratic Capital Management. We're also counting down the open of trade in Hong Kong markets. Shanghai, Shenzhen are still closed as well. Of course, we're seeing if we can continue this world-topping rally in Hong Kong here after just one day break for Labor Day. Futures are pointing higher here this morning. This is the China Show.
Brett, Japanese currency is weakening yet again after a surge for a second time. The script almost sounds like Monday and Tuesday. Speculation in the market that they intervened, no confirmation. The chief currency official came out and said, I have nothing to say on whether they did it or not. Paul Dobson's with us, our executive editor for Asian markets. Paul, sometimes you really say it best when you don't say nothing at all, is the song. Does it look like they intervened?
It certainly smells right, David. One of the telltale signs is typically a move of around 5 yen. That's pretty much exactly the scale of the move that we saw late in the U.S. trading session, and the timing would seem apt as well. Both waiting until after the Fed is done and then coming into the market at a time of lower liquidity, so it makes it easier to jolt it further in one direction or the other. So while candor is not being candid in his comments, he's continuing to leave that kind of ambiguity out there. I think the market is starting to get the message here, and yet, as you said, the yen is weakening again. That pressure is still coming back each time that we see one of these moves to kind of slap it back a little bit. And it's important because we're heading into this 4-day holiday period for Japan, and officials probably don't want to see a great deal of currency market volatility while they're trying to have a little bit of a holiday and everybody else is away from their desks as well.
Yeah. We're breaking that strap right now just to show our viewers, Paul, of this weakness that is extending in the yen right now. In fact, you're seeing moves of about weakness of 1% or so. So it really is just pairing what was suspected, this surge, and what's driven it was maybe intervention. It brings us to our next question. I mean, obviously, we knew that this would be an uphill battle for Japanese officials to really stem this decline. But are we getting closer to really 150 for dollar yen or 160 now?
It's interesting, isn't it? We might be bobbing around in this range for a little bit, but only because of that pushback that we're starting to see. It feels like the market is still very much minded to test the weekend, so the 160 rather than the 150 here. The very wide interest rate differential between Japan and the US being one thing. So what else could happen? Well, I mean, the Fed was relatively dovish, not hawkish, versus market expectations. That's a good thing for Japan. Bond yields did fall a little bit, but that dollar weakness is not really showing in a great way just yet. And it would really require something on the US side as well as on the Japan side to break this kind of cycle of ever weaker yen for us, it would seem.
Paul Dobson, thank you, our executive editor for Asia Markets there, joining us from Singapore on these massive moves and this reversal that we're seeing in dollar yen here this morning once again. You take a look at what's been going on. What we may have missed during the holiday was this Politburo meeting that happened on Tuesday night, right? So what we got overall is this, right? So policymakers, they're talking about increasing fiscal and monetary stimulus, talking about flexibility there to support the economy. Also study policies to digest the housing stockpile. There were plenty of rumors about this, slightly different from what people were actually anticipating, which is maybe that buy versus build sort of program. We didn't get that much detail in that effect in some ways. So something to keep in mind. Let's bring in our Bloomberg economist, Eric Ju. He's with us here. What did you make of what we got from that meeting?
I think on top of that, I think a key message is they set a date for the third plan.
Yes.
Yeah, the meeting in July. And I think that's, for us, probably, for me, I think probably it's a more positive message than other things, because the market has been looking for these dates for a long time, I think since last year. So it's sometimes suspicion whether they're going to stop this meeting, so they no longer care about reforms, economic policy in the long term. So I think this is a kind of affirmation that, okay, we're still going to have this meeting already, although it's probably later than the tradition, but still we're going to discuss something on the economic reforms for China in the coming years. So I think, although we don't know what they're going to discuss yet in the July meeting, but I think this is at least a positive signal that China is still on that path, right? So.
Yeah.
Can China afford to buy up some of the inventory, unsold property inventory? In other words, are we seeing, do we need to look for signs of budgetary support and allocations to do all these things that they're saying?
Yeah, I think definitely, because this is the right direction or some good ideas, how to support the economy. But the thing, we also noted that actually the specifics missing, that do you really have to, fiscal power to support those measures? So that's a thing I think we're going to look forward in the next, probably in the near term. Yeah.
All right, Eric G., our Bloomberg economist there. We're looking at the Hong Kong reopened today, so we're looking at one specific stock. We're up 15% on NEO. Let me just briefly look at what's perhaps driving this.
Monthly deliveries were up 32%.
Oh, yeah, out yesterday. There we go.
So that's how we saw the ADRs jumped up 3% in the U.S., but this is a much bigger jump that we're seeing here in Hong Kong coming back from that holiday. So there you go. We're watching that plus the rest of the Chinese EV space here this morning. And the approach to Hong Kong is looking like this. We're pretty flat in the pre-market here right now. HS Tech also not moving a whole lot. 724 for dollar China. Plenty more ahead. This is Bloomberg.
Right, just an update here on the Japanese currency following the second bout of suspected intervention, and that did not last very long. As you can see, dollar yen's back above 156. It's down against every single G10 peer by a lot right now, so we're looking at weakness of about 1% following the big drop that we had in dollar yen earlier.
Yeah, you got to wonder, right, if they did intervene, was the timing right? I mean, you could say they took advantage of the illiquidity of the market to really kind of intervene when they, if in fact it's true. But then again, it was right before this Fed meeting, and then you also have the jobs report tomorrow
coming up
as well. So are they going to continue to defend? If so, right? So that's going to be one thing that we're watching out for here today. The pre-market's looking like this in Hong Kong. Not too good. Pretty slow going on this Thursday morning here. So we'll see if we continue this rally. Analyst actions to tell you about. JP Morgan raising the industrial bank here, saying that improving revenue and earnings outlook. Sand heavy industry reinstated buy at Sealand Securities. And we're watching some of the semiconductor supply chain. TCL Tech cut to neutral at Citi.
Right. EVs are very much in focus following April delivery numbers. 15% is the big move out of NEO specifically. And while we're staying generally on EVs and energy, oil, big drop overnight. Oil counters looking like this. Going into the open today, bottom of your screens is Brent crude plus your ETF on oil. The Hong Kong Open is just ahead. This is the China Show.
Watching the China Show, we're counting down to the reopen of markets in Hong Kong after that Labor Day holiday. It looks like we're pretty slow going here so far. Maybe after this record run, or at least stunning rally we've seen in Hong Kong stocks, there's a bit of recalibration going on here as well. And even those slightly less hawkish or more dovish comments from Fed Jay Powell not really doing too much when it comes to Hong Kong here this morning. China remains shut for the last few sessions there, so we're up about 0.4% for futures here right now. A little bit of weakness in the currency this morning, Dave, but we're still tracking a lot of things, including whether there's any sort of spillover effects from this Politburo meeting that we got Tuesday night, too.
Yeah, maybe an indication of policy preference as it pertains to property. For example, we also did get some news yesterday. Effectively, one of the ministries came out and said, if you have a certain number of inventory that's unsold, then you can't buy new land that's for developers. We'll talk more about that in just a moment. Speaking of Hang Seng property, we're flat right now, as with really most parts of this market in the early going. You got to wonder why we're at work today. If you really think about it, China's closed, nothing's happening. Oh, by the way, one thing did happen. We had a rate decision in Hong Kong. No change there. HKMA, of course, thanks to the Fed. HSBC and a couple of the big movers we're tracking here on the Hang Seng Index as well. Dollar China, dollar Honky, as you can see, 782 right now. So we're flat on the Hang Seng Index. Now, by the way, and this is just a bit of a tidbit, and we'll flip the boards, please, if we can. We're up 7 straight days on Hang Seng Index. That matches the longest win streak going back to 2018. Back then, though, it's going to be hard to top that. That was 14 straight days back in January of 2018. We talked about property, glance at some of the big moves there. We're also looking at oil plays on the back of that big drop in oil prices overnight. Look at where we are. Brent crude, bottom of your screens. And very, very quickly, and we'll talk more about this in a moment, casino stocks. Very much in focus, too, at the open here. We did get some data coming through for April, I believe, on gaming revenue. And, of course, it's the holidays, so we're also trying to figure out just to what extent we are getting that passenger flow from the mainland into Macau. We're looking at maybe a move against the grain here, Yvonne, some movement across your screen so far.
Yeah, MGM China is interesting, right? That they said that MGM Resort sales hit a record as that casino recovery continues in Macau. We're going to get BI's take on it in just a second here. For more, let's bring in our Asia stocks reporter, Sang-Mi Cha, first on these markets. And you know, obviously with mainland markets closed today, Sang-Mi, what are you expecting during this holiday?
Right, the Hong Kong and the Chinese equities faltered its advance a little bit ahead of this mini golden week that we're seeing, even though the PMI numbers expanded for the second month. So we're watching the Hang Seng Index closely today and how it's on the cusp of entering the technical bull market, in fact. And it's actually had the best week performance last week, the best since 2011. So it's doing really great, but again, there are some concerns that the southbound traders, with them not here for the next few days, there would be a little change or little volatility in the market. And we're also looking at of course, the casino stocks, just like you mentioned, because of the holidays, how the MGM China and then some of the other casino operators are in focus today.
You're also looking at property. Why?
We're looking at the property because over the weekend, not over the weekend.
It feels like
it was effectively a weekend. Okay.
Just yesterday, China actually said that some of the cities that have a lot of these home stockpiles are not allowed to sell more land to the developers. And of course, that's not going to be good news for the developers. But of course, JPM just said that they are going to the right direction of divesting these inventories. And so this is not the wrong move. But in the meantime, we might see some of the stocks trending down, perhaps.
There we go. Sang-Mi Cha getting us ready for the trading day ahead, our Asia Stocks reporter. Sang-Mi just talked about casinos as really one of the groups we're tracking here today. So revenues, in fact, we got it for April, more than expected, despite weeks of really bad weather, extreme weather in some cases in southern China. Let's bring in our Bloomberg Intelligence Senior Research Analyst for Asia Pacific Gaming and Hospitality, Angela Han Lee. Just your initial take on the numbers, then we can talk about other things.
Yeah, the numbers in April was very strong just because we thought there would be some seasonal weakness. If you think about the Labor Day holiday last year started April 29. And then this year it's starting May 1st. So that means that actually less Chinese tourists has been to Macau in April, in the end of April, because the holiday started late. So for that reason, we thought some weakness there, but there was no weakness at all. So that's why we are expecting even stronger numbers in May. And it's also a bit different from the direction of other service sectors. Think about the same-store sales of Yum China and Luckin Coffee were very weak in fourth quarter of this year. So that means that we are seeing people still want to travel and spend money.
Yeah, you mentioned about, there's weaker per capita spending everywhere. You said May looks encouraging right now. What are you expecting for this Labor Day holiday this time around?
Yeah, it should be very strong for Macau because we saw that most of the rooms are very full. And it looks like people are, so if you talk about the Chinese people, it looks like they are going out more. They're not just going to Macau and Hong Kong, but they also go to other countries like Thailand, Japan, and others. So that means that probably some weakness for China travel names, I think. That's why we also see that the performance in April last year, in April this year, we see that the stock price of Shangri-La and Trip.com has been very strong, while some domestic travel names were weak.
Yeah.
I think it was 1 or 2 Sundays ago. I want to get your reaction to this. I think China introduced more measures to make it easier to come in.
Visas, right?
Visas and passports as well. What's your initial projection on how that helps? Is it easy to model that sort of thing at this point?
I think that benefits Macau more than Hong Kong. Because it means that the people who used to come to Hong Kong and Macau for business trips can stay 14 days now compared to 7 days until now. But apart from that, if it looks like they are going to implement multi-entry visa between Hong Kong Island and Macau, that means that think about Macau hotels are expensive for some people. Then you can just stay in Hong Kong Island, which is a part of China, and then just go to Macau to enjoy other stuff, maybe even gambling, but more about other facilities. So I think people can go to Macau more often and they can stay longer because they can spend less on accommodations.
Yeah, I just had lunch with some mommy friends, and they went to Macau for the weekend with their kids and a bunch of other families. And they said, we didn't even touch the casinos. They just went to the water park. So there's certainly that sort of fun there. You talk about the F&B side of things. So you mentioned Yum China, you mentioned Luckin, weak sales there. I mean, how bad are things right now? when you
we
look
saw
at the
that
consumer sector?
so think about the Luckin Coffee. It's supposed to be a chain which sells the coffee at a very, very cheap price, 9.9 yuan a cup of latte and others. And that has been very good sales like in the fourth quarter of last year. And after all these promotions, they thought that they don't have to continue doing this. It's like creating too much, like a price war. That's why they has been reducing the number or like varieties of selling at 9.9 yuan. And then they saw like a plunge of 20% decrease in same-store sales in the fourth quarter of this year. That means that see how people are so sensitive on price changes and very competitive. So I guess that also means that probably same for Yum China. Yum China sales was actually not that bad because people already having seeing that, but still the same-store sales has actually been down for KFC and Pizza Hut, and it's just because the average ticket size was down. The volume is up, but the people who pay per ticket is smaller. So that all means that people are trying to choose less expensive stuff.
Less expensive than
9.9.
9.9 renminbi for a cup of coffee. All right. Angela, thank you so much for tracking all that. Angela Hanley there, a Bloomberg Intelligence Senior Research Analyst for Asia Pacific Gaming and Hospitality. We got plenty more ahead. This is Bloomberg. Welcome back to the China Show. Some of the stories we're following this morning. China is starting sea trials for its largest and most advanced warship as it enhances its naval capabilities amid U.S. concerns. The Fujian is China's third aircraft carrier and is named after the province across the strait from Taiwan. The trial will focus on the warship's propulsion and power systems. The U.S. is barring a Huawei laboratory from approving telecommunications gear for use in the U.S. The Federal Communications Commission says the move will ensure labs for wireless devices aren't influenced by untrustworthy actors. Regulators also propose similar moves against other providers deemed a national security threat, including several Chinese companies. A survey by Pew Research has found that Americans are increasingly viewing China as an enemy. Most also think that limiting Beijing's power and influence should be a top foreign policy priority for the U.S. The findings come as Washington and Beijing have continued to spar over issues including trade, overcapacity, and the South China Sea.
Yeah, but one area, though, where perhaps there is some common ground between Beijing and Washington is really the issue of climate and climate change. Stephen Engel, our chief North Asia correspondent, is live for us right now. Steve, I believe you spoke to someone who might have some say over China's climate policy.
Yeah, Zhenmin. He is the new climate envoy for China, appointed by Xi Jinping in January. And he will be heading to Washington this month, he tells us exclusively in this interview, which we're about to play, essentially to go meet his new counterpart, John Podesta, who is America's climate envoy, replacing John Kerry. So they have a clean slate to a certain degree. But again, geopolitics have come into play into the green space with claims by the U.S. of overcapacity. Europe has echoed those. We're also hearing about potential tariffs on Chinese EVs. Again, the allegations are all about unfair subsidies and driving down the price and then dumping the overcapacity that is here in China onto global markets and distorting prices. That's the Western view. Now, it's rare when Western media like us get a chance to speak directly to a senior Chinese official. And I guess this interview that I had really plays to that, why the Chinese leadership really should offer up these kinds of interviews, because it broadens the dialogue, and that is good. So I sat down with Liu, and he has said, essentially, as the climate envoy, but he's also the former vice foreign minister of China. Also, he represented China at the United Nations. He has the diplomatic and the scientific background. He said cheaper from China is good for the global climate fight.
If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion. It means a 20% increase of the overall cost. We need to maintain the low cost. Otherwise, nobody's going to afford for this energy transition process.
And officials in the U.S. and Europe claim that China is giving unfair subsidies And that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if both U.S. court and European courts going to talk with our Chinese enterprise, you can see all these renewable energy equipment technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally, they don't receive any government subsidies. I think we should really highly appreciate the dedication and contribution by these enterprises. So after more than a decade of their hard efforts, now we have cheaper, both solar and wind products, which were now affordable to start the energy transition. I think that this is good for both for China and both for the world.
While we're talking about overcapacity, we have to also talk about the domestic economy here because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight? If the world is bifurcated on trade?
We can talk about capacity in two different ways. For the global demand, as well as China domestic demand, we're still on high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what the Chinese were doing. So there'll be high demand for the renewable energy. For the so-called overcapacity among the manufacturers, among our Chinese manufacturers, it's a temporary issue. It'll be also good that be through this kind of competition, they can continue to improve their manufacturing and make much more better products.
And Liu did say that he will be heading to Washington later this month to meet with his counterpart, John Podesta. He also weighed in on the U.S. election, 6 months to go there. Obviously, there's going to be, and we have, as we've seen, some anti-China rhetoric coming out of Washington that could be amplified. And he says the risks of Donald Trump returning to the White House is a risk to the fight against climate change, essentially because the Trump administration the last time did pull out of the Paris Accord. He says he appeals to the American public not to go that path again.
Yeah, the timing of that visit is quite crucial there, it sounds like. Steve, thank you. Our Chief North Asia correspondent, Stephen Ingles, bringing us that interview for us. Of course, if you're a Bloomberg subscriber, you can always catch up with all of our interviews by using our interactive function, TV Go. You can join the conversation, send us instant messages to our team and our guests, even questions, if you have any, during our live shows. Check it out at TV Go. This is Bloomberg. Let's look at some of the big corporate stories we're following for you today. DBS's first quarter profit rose as it continued to benefit from higher lending income and strong wealth management fees. Net income expanded 15% to $2.2 billion, beating analyst expectations. CEO Piyush Gupta says the bank saw momentum across businesses and highlighted that Treasury customer sales also reached new highs. National Australia Bank says it will buy back up to $1.5 billion Australian dollars of its own stock. The lender's cash earnings fell 13% in the 6 months ending in March 31st. Now, the CEO, Andrew Irvine, says that disciplined execution of strategy helped the bank manage the impacts of slowing growth and competition. Irvine took charge of NAB last month and appointed Rachel Slade to head the firm's business bank. JP Morgan is expected to pay an additional $100 million for its trade monitoring gaps. Sources say this is to settle a new complaint from the U.S. Commodity Futures Trading Commission. JP Morgan earlier agreed to pay over $300 million to two other regulators, including the Fed, as its settlement over gaps in its trade surveillance program. Barclays has begun cutting hundreds of jobs as the firm embarks on a massive cost-cutting drive. Sources tell us the cuts will impact several hundred staffers in global markets, investment banking, and research. Barclays is seeking to cut £2 billion of costs as part of the CEO's plan to boost returns.
Yep, we talked about the Fed there. So in case you missed it, held rates, no change there. Fairly hawkish statement, fairly dovish press briefing. We got the views from Bill Dudley, the Bloomberg opinion columnist, of course, and also the former New York Fed president. Now, he's of the opinion that the latest comments coming out of Jay Powell show that the central bank is actually on track with its current rate strategy.
He basically said that despite the news that's come in, economy stronger than expected, inflation not so good in the first 3 months of the year, the whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike. No hint that it's not going to work. So the market reaction, I think, was pretty appropriate given what he said. He basically said, we've got it.
Back to Dudley McKelvey of a few years ago. Bill Dudley, you're in the trenches at Goldman Sachs gaming the labor economy. What data in the labor economy is important to Chairman Powell to really become accommodative?
Well, I think it's the notion that the labor market is really starting to somehow fall apart, and the unemployment rate is starting to rise significantly. He was asked pretty explicitly about that, and he basically said 1 or 0.2% rise in the unemployment rate wouldn't really disturb him. I think the interesting question is, if the labor market really starts to deteriorate, the problem is that the next stop typically is a recession. We've never had a 0.5% rise in the unemployment rate without having a recession. So I think it's, if the unemployment rate goes up a couple tenths, I don't think it really bothers them. But if it feels like the labor market is really giving way, then the Fed will put a lot of weight on that, almost regardless of what inflation's doing.
Bill, you said something. He basically said, we got it. The playbook hasn't changed. Was that the right move?
Well, time will tell if the playbook will actually work as well as he thinks. I mean, my own personal view is that the legs of monetary policy probably are not as long and variable as he thinks. And I put a lot more weight on financial conditions, I think, than he is currently. The fact that people are taking his comments in a very positive way from a financial market perspective means that we're having an easing of financial conditions, which will support the economy. So I think it just reinforces the higher for longer story over the medium term.
There we go, Bill Dudley, Bloomberg opinion columnist and former New York Fed president. Just for a look at markets right now, so a couple of pockets of this equity market we're tracking, and there we go. And why? On your screens, why? NEO's up 17% and out with some delivery numbers across the sector, to be more specific here. This is for the month of April. We're up 18% on that stock. Others are perhaps not playing as much ball, but all that being said, as a group, these names seem to be moving against the grain of what's really been just cautious trading across markets here in Hong Kong. Oil stocks, that's fairly consistent with the drop in, I think, Brent's at 83, New York crude's below $80, and as you can see across the region in the markets that are open, you have PetroChina, Costco Energy Transport is a stock traded here in Hong Kong, S-Oil is in Korea, and Woodside, of course, is over in Sydney. Those are seeing declines, unexpectedly so, 1 to 3%.
Yeah, I mean, there was talks about, ceasefire talk, whether those talks are going to go through. That's really kind of reduced the risk premium. You also have these U.S. inventories that are piling up as well recently. So that's why maybe that drop in oil is holding here in the Asia session here today. But yeah, overall, your Asia dashboard's looking like this. You're still seeing some decent gains across some equity markets here in Asia. U.S. futures, we talked about, it's rare to see about a half-point move on the U.S. So maybe it could be boding well for that Thursday morning for you guys on Wall Street. But really, it's mostly green in terms of sectors, with the exception, as Dave talked about, energy, tech as well, and real estate here in Asia. GMM's looking like this. It's all sorts of colors here this morning, but really what's been the big red is Japan and the yen. There you go. We're up some 1%. And that certainly is sort of, are these traders just kind of betting for another round of intervention? Or at least they're daring the Ministry of Finance to do it again if, in fact, that's what you've been doing the last few days or so. But really, the last 2 days of gains that we've seen are quickly evaporating now, too.
So at these levels, 156.22. It's reversed about 75% of the way now in terms of just that gap lower earlier on in dollar yen. While we were talking about that, we're also getting a lot more commentary coming through on this Politburo meeting that took place and some of the headlines coming through there. This time, HSBC is just dropping this note. in our inboxes talking about how, for one, we haven't even talked about this, but the significance of the third plenum coming through, and no specific date, I believe, but we know it's in July, for example.
Yeah, and I think the fact that top leaders are even talking about digesting the existing stockpiles in the housing market and the supply issue and really trying to come up with some solutions around that is going to boost sentiment. Does it turn around the overall picture? Maybe not, but at least it's a first step in the right direction. Yeah,
more
something new at least.
Constructive. There we go. Plenty more ahead here. You're watching The China Show. Happy Thursday.
Welcome back to the China Show, Hour 2. Here's a look at the HSI half hour into the session and coming back from that Labor Day holiday. And we're actually seeing a little bit more momentum come through. We're up about 0.7% here this morning. But yes, as Dave, you've been talking about, it's pretty slow going at first. Looks like things are picking up now, but volumes are watching very closely too.
Yeah, we're about 30% lighter than your 30-day average, which should not come as any surprise, really, given the fact that, the one source of flows that is shut today is the stock connect, of course, right? So we've been talking about this day in, day out the last, 2 or 3 weeks or so, nearly every day of inflows so far. So let's see how this market holds up, as that sort of avenue of entry is dried up effectively because of the markets being shut. We'll talk more about that later. The other big story that we're tracking here today, this is a look at dollar yen. So that's Thursday, Friday. There's a drama on Monday. This was Tuesday, Wednesday, and this is where we are. So we woke up this morning here in the Asia Pacific, and we were wondering, did someone wake up and decide the yen was cheap? There's no confirmation, of course, out of Japanese officials, so they intervened again. It's quite a wide range you've had. Now, since that point in time, we retraced now about 75% of the way up. Rate differentials is a completely different story, really, and the question now is, even if they did intervene, of course, to what extent is that going to stabilize things, and what range we're talking about here, given the fact that rate differential is still quite high? Now, they came out, Japanese officials, and said there's nothing to say as far as something to see is concerned, and we'll certainly have to wait a few more weeks before we do get confirmation from those numbers when they do come out of that end of May. Very quickly, the mood across these markets right now, U.S. futures are up 0.5%. Asia's doing better than we were about 15 minutes back because of the pickup we're seeing here in Hong Kong. We're looking at what's happening in oil prices, a bounce, but we're bouncing from fairly low levels now, 83, 84 as far as that's concerned. The move across the treasury markets, we're looking at yields pushing even lower at this point in time, although you could call that trading sideways, really. The big move really was overnight. We dipped below 5% on the 2-year yield, for example. And currency markets are doing this. Iron ore, I'll leave you with this, just final thought. We're coming off one of the best months so far in years. 17% move up in iron ore prices in April, and we're continuing to see that to a lesser extent, Yvonne, up 1%.
Yeah, I mean, the moves in the treasury markets, perhaps, of course, a little bit of what the Fed said, but I think the announcement of an earlier start to the reduction of QT, and one that was actually deeper than expected in terms of that cut, that certainly is, I think, maybe why we're seeing this treasury market breathe a sigh of relief in some ways as well. Let's bring it back to the Fed and what we heard from Jay Powell, who talked about the need to keep rates where they are. Take a listen.
In recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I do think it's clear that that policy is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer. I think it's unlikely that the next policy rate move will be a hike.
So you really kind of thread the needle there, but really what we saw post that FOMC presser was that yields dropped, the dollar took a bit of a drop. Maybe that helped the yen in a little way. But Mark, what do you make of these moves in dollar yen the last 24, 48 hours or so?
It'd be very surprising if that wasn't intervention that we saw late in New York last night. The timing of it was very good from the Japanese authorities' point of view if they did it, because they waited until very late in the New York day. By then, a lot of people have already finished and packed up for the day's trading. So to do it then obviously has a much bigger impact. And they must be getting the sense that they need to pick their timing very, very carefully because they're up against an enormous market. Apparently, the foreign exchange market is something like $7 trillion a day now, which has almost doubled since the global financial crisis. And they're intervening with a matter of billions of dollars. So you can see they're up against a big mountain here. Now, people think that they spent about 35 billion US on Monday, still to be confirmed, of course, in the official MOF data. But you can see that didn't have a huge impact itself. So it's more about the timing. You have to get it quite right. You have to catch traders off guard. And doing it late in New York is certainly a very good time because you can move the market with smaller amounts of money. But they're probably going to have to do it several more times. People will be looking at this long weekend. Japan's about to have a 4-day weekend. And purely on a cost of carry basis, it actually pays people to be long of US dollars over that weekend. So they need a very strong incentive not to be buying dollars and selling yen. And the Bank of Japan, through the Ministry of Finance orders, they'll just have to keep on doing it. The ideal position would be for them to get dollar yen below 152 before the weekend, because that was the big breakout we saw after the April CPI numbers in the United States. And there's pretty good evidence that people have been selling more yen after that CPI number. So there's some fairly fresh positions in there, which could be flipped fairly quickly if the authorities can get dollar yen under 152. They didn't quite make it last night. Maybe they'll try again tomorrow or before the weekend.
I was about to say, so should we effectively be bracing for possibly, another round of suspected intervention before the weekend to get us to that level, because we're about 4 yen from that, which is quite a bit of distance here, Mark?
Yeah, I think there's a very high chance. And if you see what Masaki was writing about on MLive earlier, when the yen moves by at least 5 big figures, that's usually an indication that somebody with a very big hand is giving it a shove, and we know who that is. So they just about managed it last night, but they probably need to push it again. Is that the traders don't seem to be convinced yet. But it did, if you think back to 2022, there had to be several rounds of intervention before the market really got the message. And of course, at the same time, they were getting help from US yields, which were falling fairly quickly, which is not really the case this time round.
Yeah, I mean, I'm just taking a look at broader markets here right now, Mark. The Hang Seng's up another 1% again. That's despite even getting mainland investors to take part in this. The Fed, I'm just wondering what your take is. I mean, it seems like he was threading the needle. He was. The statement was hawkish. They added that extra line talking about, that lack of progress to getting to 2% inflation. But then he ruled out the possibility of rate hikes. What does this mean for risk assets now?
It was a pleasant surprise. If you're in the equity market or the bond space, what Powell did yesterday was a better than expected outcome, because he could have been a lot more hawkish than he was. Obviously, by saying no rate hikes, that was some kind of comfort to the market. But probably more important was what you spoke about earlier, the QT numbers. Because by bringing that threshold down much more than expected, he's taking pressure off the bond market. He's not reducing the Fed's commitment to the market by as much as was expected. So he's really helping the bond traders out here, and it's going to happen quite quickly. By June already, they're going to see an easing of the Fed reducing its balance sheet. So that's a net positive for the bond market. Doesn't mean to say that yields are going to slide dramatically, but it does take away one negative element. He's also said that there won't be rate hikes as well, even though it's getting tougher for them to justify lower rates. But at least net, it was a positive signal to both equities and bonds.
Mark, thank you. Mark Cranfield in Singapore for us, our MLive strategist there. Just ahead here on shows, we'll dig deeper into the Chinese story here with S&P Global Ratings. They put out a recent report here effectively talking about developers and maybe question mark, bracing for a third wave of default. Charles Chang joins us in a couple of minutes. This is Bloomberg. Welcome back You're watching the China Show. President Xi Jinping is convening senior party officials in July. That's for a closed-door gathering. Now, that meeting is closely watched for any long-term policy signals. And a date for the so-called third plenum was announced after this week's Politburo meeting. Now, it's the first time that the plenum will be held in an off-schedule year in over 3 decades.
Yeah, we've talked to several people about, that at least confirming that meeting is actually quite significant given it's been delayed. So certainly that may signal we might be getting more news on the stimulus front and the like here. But what we also got from that statement, from that meeting, was everything about, monetary policy, maybe more of a push to fiscal policy, the flexible use of that interest rate in the RRR. They also want to study policies to digest the housing stockpile. This was something that everyone was sort of chattering about leading up to this meeting about, was the government going to step in to buy up some of the stockpiles from these developers and what to do with it, right? But certainly that's one thing we're watching out for as well. And of course, we're going to talk about the corporate debt side of things in China. S&P finding that the real estate sector has $34 billion worth of offshore bonds maturing this year. They've also conducted this long research about where we are when it comes to defaults in China. Let's bring in Charles Chang, MD and Greater China Country Lead for Corporates at S&P Global Ratings. Charles, it's always great to have you. I just want to get your take. The fact that we're hearing maybe this new plan to fix the property market and the supply issues there. How significant is that?
I think it's significant to the extent that the government continues to be very proactive on this. I think the thing that we're watching is that the government continues to find solutions to these problems. Unfortunately, the latest set of measures relating to the whitelist don't seem to be kicking in very quickly. So sales in the first quarter are still very weak and actually weaker than what most of us expected. So the whitelist may need yet more time to take into effect. And in the meantime, it seems that the government is not sitting on their hands and waiting, and they're trying to find other ways to tackle this problem.
Have you noticed an improvement in sentiment? At least you talk to a lot of people in the market.
Well, among investors, the sentiment is basically more or less the same. Among home buyers, we're seeing sentiment take a step back, and this is showing up in the first quarter sales numbers. Some of the sales figures that we've seen, even for the biggest and government-owned developers, are down anywhere from 30 to 35%. So that's quite a big drop, and that's coming from people who are still quite concerned about home delivery, about buying the homes that they purchased, getting the homes that they purchased. So that sentiment doesn't seem to have really been reversed by the whitelist. It may probably need more time for that to really be anchored. But as it stands right now, among the home buyers, it seems that the sentiment is still quite weak.
And property obviously has been what drove a lot of the defaults in what you're calling the second wave. Where are we now in this cycle?
Well, we're in the trough of the second wave, basically at the bottom. So in this year's study, this is a study we did every year. Every year we try to find something notable to say. 2 years ago, we noted that the market seems to be seeing bigger and bigger defaults, and that the government's tolerance for it seems to be getting higher. And lo and behold, a couple months later, Evergrande fell into distress. So this year, what we found is a distinct wave-like behavior of these defaults. And these waves don't seem to be timed with economic cycles. They seem to be timed with policy cycles. So we found that when you kind of map it to the contractions in the financial markets, that the major contractions, particularly in shadow financing, seems to have been triggered by some of these major policies. First in April 2018, which is a fight against shadow financing through the asset management market, and then in January of 2021, when the 3 red lines against the real estate excessive leverage policies came out. And in both of these instances, we saw a major contraction in financing conditions and a wave of defaults that followed. So this is something that we're looking at now. The concern, I think, that we get from this year's study is that the default rates now are so low that it doesn't look like a result of the functioning of the market. Right now, it's about 0.2%. Globally, it's about 2%. So that gap is quite wide and to a certain extent not particularly natural. So the question that I think in our minds is that what's going to happen when some of these directives against bond defaults in the market, when that gets taken out, what happens then? Are we going to see another wave? Because then the government will be in a position to allow the market to function. So that's what we're watching for in the near term.
Do you think they've loosened policy enough to prevent, as you mentioned, arguably the two waves were caused because policy was too effective to some extent? You know, what would be the trigger for a third wave? Do you see a trigger? And what will be the natural default rate given the fact that you think it's artificially low?
Well, I mean, the natural rate, I suppose, if you want to compare it globally, that's probably the place where we start. Right now, it's about 2% range, whereas China is 0.2. So that's a very low default level. Now, when the government start to allow the markets to function, one thing I think we need to keep in mind is that it's not necessarily the government's objective to eliminate or to reduce defaults. The government's objective that they have stated repeatedly in the recent years is to improve the efficiency of growth in the country. And if efficient growth is what they're looking for, then you need to ensure efficient capital allocation. And the bond market and the functioning of the bond market is very important for that. So at some point, perhaps when the government is more comfortable to allow the markets to function, we should see default rates go back up to a more normal and typical level.
What's normal? What's a reasonable level now for default rates in your eyes then?
Right now, if you compare it to the global benchmark, it's about 2%. Okay.
What does this look like for 2024 then? You mentioned if we start to see those default rates pop up, are debt restrictions going to be, you're going to see more of that? Is it really just going to be focused on the property sector, or do we have to broaden it out a little bit wider now?
Well, the restructurings are happening right now, and we're seeing more and more cases of restructurings happen, particularly in the real estate developers. And I think that's because a lot of these cases have dragged on for a year or two. So it comes in the aftermath of a default wave, and we're now in that aftermath. So we see more restructurings, happening, and also we're seeing more winding up petitions. Investors are getting impatient in some of these situations and filing winding up petitions. So the next thing we should be seeing is more of these restructurings occurring, but perhaps at the same time more defaults occurring when we get into a more normalized market condition. Just one thing to note is that if these defaults are timed with policies rather than economic cycles, since policies tend to be counter-cyclical, we could very well see defaults pick up at the top of the market, not at the bottom of the market.
As the economy improves, counterintuitively.
Yes.
Yes.
I wanted to then ask you about, the functioning, is that right? The functioning of onshore bond markets? Because what a part of this has done is, corporates who haven't been able to access the bond market are now looking at the banks for that financing. Are you seeing that dynamic start to shift back into the bond markets? Who dominates the onshore bond market this year, for example, in terms of supply?
Well, you're right. Over the past year, the corporates in the country have increasingly shifted to banks. I mean, they've historically relied mostly on banks.
On banks anyway, okay.
Yeah, exactly. So, but that percentage went from 85% to 88%. So it's quite an extreme level. And to a certain extent, that's not necessarily what you want, because you do want some market forces to play out in credit allocation, and that's what you get in the bond market. So over-reliance on the banking sector is not necessarily positive. So we would expect that to also go back down to a more normalized level. That's something that we're seeing a little bit this year. So issuance onshore has ticked up in the first couple of months. So that's a positive sign. Hopefully that continues and we see more issuers come to market and more of that play out.
But are those private issuers, or are those mostly still sort of the LGFVs of the world, for example?
Mostly the stronger LGFVs.
The stronger LGFVs.
Exactly. So in the last year, we've seen the weaker LGFVs essentially, get shriveled out of the market. And the private issuers have also seen very little issuance. So both of those groups are, seeing very limited issuance or net negative issuance really in the last year or two. So it's the stronger LGFVs that have been able to access the onshore markets unimpeded. But even for them, the issuance level is quite low from a historical perspective.
Charles, fantastic report. Hi to your team for us as well. Charles Chang there, MD, Greater China, country lead for corporates at S&P Global Ratings. Right, Hang Seng Index, there we go, 18,000 now. So this should just put us within reach, if not already, on track to enter a bull market. More on that story just ahead. This is Bloomberg. Right, welcome back to shows here. So let's talk all things markets here. So KKR CFO here says he doesn't see any Fed cuts this year. So Robert Lewin was speaking with Bloomberg after the firm's first quarter profit topping estimates following a new reporting metric, KKR rather. There we go.
Since the beginning of 2022, we've raised about $180 billion of capital, which is a really healthy number for us. But we've been able to do that without a lot of our large flagship strategies in the market. So as we've talked about the go forward, we've talked about fundraising being able to accelerate from here. If you look at where a lot of that capital raising has been over the course of the past, number of quarters, in Q1, we had a final close of $6.4 billion in our Asia infrastructure strategy. That's the largest fund by a good margin in Asia Pacific focused on infrastructure. Lots of real good tailwinds there in terms of longer-term growth. A lot of capital raising across our credit franchise. That's asset-based finance. That's direct lending, leveraged credit, north of $20 billion in just this quarter alone. So there's a lot of momentum for us across capital raising, and we would expect that to accelerate. What we've articulated to our investors is we believe that we could raise $300+ billion of capital over the course of the next 3 years.
How do you think about what the investment opportunity looks like with rates potentially staying at this level or not much lower?
So one of the unique things about our model, right, is we have over 200 companies that we're invested in across the globe. So it gives us a pretty good lens into what's going on from an economy standpoint. And we're seeing goods inflation come down. We're seeing shelter inflation come down. We are seeing core services inflation remain stickier. And we've been feeling this way for quite some time, and we've been able to position our portfolio to be able to address this. And so we do see interest rates coming down over time, but we don't see any cuts in 2024. We would expect the 10-year to probably come down to somewhere around 4% plus or minus, but all been very front of mind for us as we pursued investment themes. We've been focused on businesses now for some time that we feel can sustain margin in a higher cost environment. You're really seeing that play out in our portfolio, really healthy. Back to we've driven real investment performance on behalf of our clients again this quarter and over a longer period of time, so we're quite proud of that. And back to areas where we've been leaning in, asset-based finance, infrastructure, both have a component of inflation protection baked into those asset classes.
KKR CFO Robert Lewin there. Take a look at this market, and Hong Kong is finally waking up. It seems like they just need a few minutes to wake up and come to their desk.
Needed that Wednesday.
Right? I mean, it feels like almost like a Monday, but it's not. There you go. 18,000, back to those levels here. It's a day 8 if we continue to see an end this way. And in fact, if we are actually closing at these levels, we are set to really enter into a bull market by the end of today. So we're up about 1% or so for H shares, 1.5% moves there. H is tech. There you go. Things are really firing up here. We're up about 2.6% overall, and we're checking very closely what's really driving this. The EV sector certainly is one thing to watch. Casinos are doing very well here today as well, Dave.
Yeah, so Sense Time is up again. It might also have to be one of the big movers here as well. Are we looking at HS Tech? Yes, we are. So you're looking at NEO up 19. Sense Time is up 10%. In fact, no, it's now the opposite. They're both up 20% as we speak. Meituan, we're still trying to figure out what's moving. I've been looking at some of the headlines. I can't quite figure out just yet, but as you can see, that's also adding to this rally across some of the EV places Yvonne is pointing out. We're just headed into the Tokyo lunch break where we are ever so slightly just above water. And dollar yen has been all over the place this week. 160, 153. We're back to 156. And flat. There we go. Plenty more ahead. This is Bloomberg.
The whole game plan is basically unchanged. We're going to keep rates here until we're highly confident that we're going to get inflation down to 2%. No hint whatsoever of a rate hike.
I think there's a lot of relief here that the chairman stayed true to what we've seen from this chairman.
I think Jay Powell was particularly disciplined here. I think he stayed on message very well. There's a clear bias towards easing, and he stuck to that.
They've left wide open the question of why has progress been less than they expected on the inflation front.
Let that tight policy work for longer. I think that's about as far as they're ready to go today. That's hawkish in May. We'll see what hawkish might look like in June.
This is really good for the markets because here's a Fed that's telling us, look at the longer term. Look where inflation was and look where we've gotten it to. Don't worry about the last couple of months. We'll see what happens there.
All right, some of our guests reacting to the latest Fed decision. Welcome back. You're watching The China Show. Asian markets are doing this. There's a little bit of that optimism flowing through some of the equity markets here in Asia. Certainly one to watch. Hong Kong certainly is getting fired up all of a sudden here. So, we don't really need those southbound flows, it seems, here today. We continue to see quite a bit of outperformance there. And that's why that's punching the Asia Pacific index up about 0.7%. U.S. futures are continuing. That's like session highs right now. And the dollar continues to stay pretty weak.
Yeah, so markets have been taking this one well. Just a couple of things to note here. So we are going into Apple's coming out with earnings. That's number one. And number two, of course, the jobs report. And maybe, just maybe, who knows, something out of Japan before we enter. Yet, by the way, that market is shut tomorrow. So not that that would be exclude any possibility of a big move in dollar yen, but just to watch that as well. Right. Let's put all things together for you, market-wise. John Woods, Asia CIO, Lombard Odier, joins us right now. Nice to see you.
Nice to see you too, David.
The takeaway so far from this Fed meeting was good for markets, good for risk assets. Agree? Disagree?
Yeah, no, I agree. I mean, the market went in quite concerned that there was going to be some hawkish shock from the Fed. That didn't happen. In fact, if you look at the implied probabilities, both from interest rates all the way down to the performance of bond yields and the dollar, actually there was a small positive dovish tilt subsequently to the market. So our view is that this base case of a decelerating inflation or a mild recession, a mild soft landing is likely to play through. And so I don't think there's any major risk to base cases around the market right now.
So do you think rate cuts are just delayed, not so much derailed at this point? Do you think this is a Fed that can still cut in the second half of this year?
I mean, the market is pricing in only a moderate possibility of that happening. Although I would point out we've gone from 7 cuts at the beginning of the year to less than 1 at the end. So the pendulum is swinging, I think, in quite a volatile way. Once the disinflationary trend begins to reassert, and I do think that's going to be apparent, even in the jobs market, in the weeks and months ahead, I think maybe interest rate cuts can get repriced.
Well, what's the prescription then? 60-40. On the 40 part, is it more duration? On equities, do I build more exposure to equity markets at this point? S&P's back at 5,000, for example. Asia's done very well.
From an allocation perspective, actually, we're tilting closer to 50-50 right now. We're biased towards fixed income. We have an overweight there. We suspect that once interest rates do start to cut, then we will see a rotation from cash into bonds, in particular a mid-duration, David, to your point, in the IG space. That's where we think the sweet spot will be found, and that's where I think the highest likelihood of capital gains is likely to come from. But at the same time, earnings are looking quite resilient, quite constructive on the equity side. So that 50-50 allocation, I think, makes some sense.
Is that still mostly in the U.S. then? Is there any other equity market that you see in this universe that could actually beat what we're seeing in the U.S.?
I mean, we're obviously buyers on dips of countries like Japan and India. These are major markets. Maybe China not so convicted, but yes, it's overwhelmingly a U.S. story for now.
Why not China?
I think China's a tactical play, David, right here. I think it's a trading opportunity coming from, I think, a very light positioning, particularly amongst foreign investors. And we're seeing some flows into that, particularly as they rotate out of tech. I think that will benefit China over the near term. But my sense is that consumption as a swing factor, which for me in China it is, still remains quite depressed. Broadly, I look at retail sales, I look at home sales, I look at consumer sentiment broadly, and I don't see any green shoots in that critically important space. And until I do, I think I'm looking at the equity market as something as a short-term trading opportunity rather than a medium or long-term investment case.
So the U.S., I'm just wondering, though, then, if that's still the better, I guess, house in the street. Is the earnings picture going to be able to sustain this rally in some ways and maybe overshadow what we've been hearing from the Fed?
Well, we're getting Q1 numbers now, aren't we? And again, they're not remarkable, but they're not unremarkable. We've seen EPS growth of around 6-7%. We're looking at earnings growth for the whole year at around 10%. And in my mind, that is looking reasonably constructive. I mean, perhaps not as good as last year, but next year, 2025, that earnings growth could tick a little higher to 13%. So I think you can make a case that earnings is likely to sustain performance, and ideally, breadth of the market starts to widen as well.
You mentioned Japan. What's the case for Japan now that we're at 40,000, that the bulk of the gains are not behind us but ahead of us, for example?
Well, over the medium to long term, David, I think this is a consumption story. I think this is a renaissance in Japanese consumption. It derives from a shrinking working population, upward pressure on wages, greater spending, greater corporate revenues, and subsequently earnings and profitability. That's where I think the case is. It's very much a domestic story. I don't think it's so much a story driven by foreign investors. And certainly the weak yen has helped derive and generate momentum and gains from that side. But into the medium term, I think this is a domestic story, actually, and I think it'll be Mrs. Watanabe essentially selling bonds and buying equities, which is exactly the opposite to what I think will happen in the States. But Mrs. Watanabe will be unwinding her position in the post office savings, which is essentially a JGB story, and putting it into equities. And I think that's the next leg higher in the Japan equity case.
What do you make of what's going on in the currency, though? I mean, just given the massive volatility that we've seen.
Yeah, I mean, to me, that's concerning.
Is that going to be a factor for the equity market in any way?
It is quite concerning for me, and I think we've already actually seen intervention. We won't actually have hard evidence of it until the end of May, but I think we're already actually seeing intervention, and that's probably necessary to smooth the yen into the second half of the year. But actually, when you look at Asia as a whole and observe the extraordinary yen weakness we've seen, we start to get concerned, don't we, about relative levels of competitiveness, particularly with China. And you'll probably be aware of these deval stories coming out of China on the back of the gold speculation, on the back of southbound flows into H shares, all as potential currency hedges. And you have this sort of Damoclean sort of yen weakness hanging over everything. So to me, that is a risk that I'm quite focused on in the Asia space right now.
I mean, you've watched this market for a long time. You know, we were talking about this a few days ago. I mean, the yen went from, I don't know, 85, 90 to 160. It's effectively halved in value over 10 years. Why hasn't that been a problem? It's just been bizarre to me how no one's really pushed back at that.
Well, I mean, in previous instances, David, of course, you'll be aware that it actually caused a huge amount of turmoil and volatility in global currencies, and we had these very famous Plaza Accords, etc., which were convened to address that. I think right now the monetary phenomena or the monetary imperative is overwhelming yen weakness. And actually, if you look at renminbi, if you look at euro, if you look at the dollar, they've been relatively well behaved. Actually, it's only the yen that's gone AWOL and off reservation. And, you know, were they really to start tightening monetary policy a little more at the margin, I think possibly you could start to see some strengthening with the added threat also of intervention. But as I say, from an Asia perspective, this rampant weakness does concern me from a pure relative competitive level.
Okay, John, thank you so much. John Woods, there, Asia CEO at Lombard Odier, joining us here in our Hong Kong studios. We've got plenty more ahead. This is Bloomberg. All right, there you go. HS Tech's up from 3% here right now, and we are seeing this Hang Seng really getting into that bull market territory here if we continue to see these gains of about 300 points or north of that here this morning. 18,066 for your Hang Seng. It's an 8th straight day of gains. Looks like we're continuing on this winning streak here, the longest we've seen since 2018. We're talking about this one other story here right now. The U.S. is barring a Huawei laboratory from approving telecommunications gear for use in the U.S. The FCC has also proposed similar moves against other providers, including several Chinese companies. Let's get to our executive editor for Asia Technology, Peter Elstrom, joining us from Tokyo. Peter, just maybe tell us how significant this move might be and what is the U.S. essentially trying to achieve?
Yeah, sure. It's a little bit of a strange development. So the Federal Communications Commission, the regulator for telecom communications in the U.S., is deciding to ban Huawei and some of these other companies that you mentioned from participating in what's really the authorization of technical standards for gear that's sold into the United States. So the FCC relies on these private labs to do a bunch of testing around, do things conform to technical standards like radiation levels or what frequency certain things are operating at. And Huawei had been participating in that. That's probably a bit of a historic artifact. Huawei, of course, had been very active in telecom networking equipment and smartphones and the like, and in the past had probably participated in these kinds of technical authorizations. But more recently, and this has been going on for years, the U.S. government has been cracking down on Huawei. It's been barring its equipment from being used in the United States. It's also gone to allies and tried to get them to pull telecom equipment out of their networks because of national security reasons. So there's a little bit of a leftover artifact here that Huawei was still participating in these kinds of authorizations.
Peter, let me combine just two questions for you. I suspect the answer to one will be very short. Have we heard from Huawei as a response to this, number one? And number two, on Huawei, but in a different story as well, we're getting some numbers coming through eclipsing Apple. What can you tell us about that?
Yeah, on the first point, we haven't formally heard from Huawei on this front, although it has said repeatedly that its equipment, its company, does not represent any sort of national security threat. So it's been very clear about that point. You're referring to their earnings in your second question. Yep. You're referring to their earnings for the first quarter. Very strong results out of Huawei. Their profit, probably the headline number, is that the profit increased more than 500%. So just a huge explosion in profit at this point. They don't give a whole lot of breakdown about which businesses are doing well. The company's two primary businesses are telecom equipment, so what you put into the backbone of telecom companies around the world, and then smartphones in particular. It had almost been knocked out of the smartphone business because of the blacklisting from the United States. It couldn't get key components, including semiconductors. But as we've reported, and we've talked with you guys about a few times, they now are getting some of those semiconductors that they need for their smartphones domestically, and that's led to this huge increase in their smartphone business. We saw shipments up about 70% in the first quarter, and as you alluded to, that has hurt some of the foreign players, particularly Apple, which has lost a lot of ground as Huawei has sort of come on strongly.
Peter, thank you. Peter Elstrom, our executive editor for Asia Tech in Tokyo. For us, we'll leave you with a look at currency markets, where it's generally a story of a softer dollar, but curiously also a softer yen. To the comments of our previous guest, John Woods, the yen's gone AWOL. This is Bloomberg. Welcome back. You're watching The China Show. China's top climate chief is set to meet his U.S. counterpart in person for the first time next month. Speaking exclusively with our colleague Stephen Engel, Liu Zhenmin says he also sees common ground for the U.S. and China to work together on climate issues.
I shall bring a delegation from different ministries looking after different issues. I think we are looking forward to have a very sincere and practical conversation with our U.S. counterparts, to start the cooperation in some areas.
How do you see, in the United States, they've had a changing of the guard as well, Mr. Podesta, how do you see that relationship building?
Between China and the United States, we had relatively good cooperation ever since the last 30 years for the climate change process. Of course, over the 30 years, during the Bush administration and during the Trump administration, U.S. stayed away from the climate process. But on the rest of the years, we had very good collaboration.
Is it even possible to have a separate dialogue, diplomatic dialogue on climate, because there are a lot of other very contentious issues that are clouding the U.S.-China relationship? Is it possible, or would you rather see a more dedicated climate dialogue in separation from say, the other issues that, whether it's the South China Sea or geopolitical relations, and that's really clouded and deteriorated the U.S.-China relationship?
China-U.S. relationship is really very complicated. But I think for climate change, both China and U.S. has a common but differential responsibility, and we have to cooperate and as far as possible to continue to lead the global process.
What happens if Donald Trump is reelected? What's your view?
That's one of the worry in this climate change community. I definitely hope that the American people will support the government to stay in the climate change process, stay in the Paris Agreement, even Trump wins the next election.
In March at the Boao Forum, you said protectionism and economic competition are becoming another problem for the global fight to combat climate change. How much is this holding back the global fight for climate change?
When I mentioned that issue, I think I'm focusing on the impact. If this protectionism, unilateral measures, these non-trade tariffs, will definitely, if our partners, North American and the European partners continue to follow this practice, not to talk about trade, it will impact the global process. If the Western countries continue to insist to decouple from the imports of the China products for clean energy, it will cost the world for maybe additional $6 trillion. It means a 20% increase of the overall cost. We need to maintain the low cost. Otherwise, nobody's going to afford for this energy transition process.
And officials in the U.S. and Europe claim that China is giving unfair subsidies, and that has led to the situation we're in right now that could distort global trade in these clean products. How do you respond?
I think if both U.S. colleagues, European colleagues, going to talk with our Chinese enterprise, you can see all these renewable energy equipment technology, they are innovated and developed and manufactured by our private companies. This is very unique, very unique. I think private companies normally, they don't receive any government subsidies. I think we should really highly appreciate the dedication, the contribution by these enterprises. So after more than a decade of their hard efforts, now we have cheaper, both solar and wind products, which were now affordable to start the energy transition. I think that this is good for both for China and both for the world.
While we're talking about overcapacity, we have to also talk about the domestic economy here, because we've been seeing profitability sink at a lot of these solar companies and EV companies. Price wars are driving down their margins. What does that do to the climate fight? If the world is bifurcated on trade?
We can talk about capacity in two different ways. For the global demand, as well as China domestic demand, we're still on high demand for the renewable energy products. Because for the Chinese government, I think we're determined to increase our renewable energy capacity to a high percentage, maybe over 80%. I think for the next decade, we're still in the process of increasing our renewable energy capacity. Globally, I think that's much slower than what the Chinese were doing. So there'll be high demand for the renewable energy. For the so-called overcapacity among the manufacturers, among our Chinese manufacturers, it's a temporary issue. It'll be also good that be through this kind of competition, they can continue to improve their manufacturing and make much more better products.
That was China's Special Envoy for Climate Change, Zhenmin, speaking exclusively with our chief North Asia correspondent, Ingles, in Beijing. Checking these Hong Kong markets now, and it is on fire. Take a look at of these tech stocks. HS Tech is catching a massive bid here this morning. Wow, 29% gains for SenseTime. NEO is also up some 23% on the back of those April delivery numbers. Meituan, Xpeng, these are some of the big tech heavyweights that are really punching up much higher here this morning as well. So the tech space is doing very, very well. We're watching property as well. China Vanke, there you go, is up 11%. So there's talk about, the China banning these cities with big home stockpiles from new land sales. This Politburo meeting talking about they're finding solutions to deal with the inventory side of things, or at least the supply issue in China. That's lifting this industry here. Ticklet Longfor is also up close to 9%. And we're watching the move in oil, obviously, with that drop in oil prices. We talked about WTI back below $80. That certainly is leaving a drag here, at least in the energy space. You're seeing the looks of PetroChina down some 3%, Dave.
Yeah. More in this market, right? So the Hang Seng Index, MSCI China are now up 20%. We just stopped short of that early this week. So as things stand, we are on track to enter a technical bull market, which is 20% from a certain low. Maybe more in that Politburo meeting that took place because, the type of price action you're seeing in property in particular, when you get a day where you have 10, 15% gains is indicative, based on what we've heard from our guests, of really a sea change on policy and the magnitude towards property, right? So on the Politburo meeting, for example, one of the things that stood out was it was the first time in a readout from that meeting that they'd mentioned either interest rate cuts, or interest rates specifically, or reserve ratio requirements. The first time it mentioned those two things, policy tools, since April 2020. What happened in April 2020, that's when the pandemic first hit, and China's economy, of course, was trying to get itself stabilized, of course.
So at least there's a chance that monetary policy could still be a big play, maybe later on this year. You have to wait maybe until the Fed moves or the ECB moves, right? I think, but BE was saying that's in line with what they're projecting here, that, we could still see some cuts when it comes to RRR, when it comes to maybe even the LPR. But I think that what I really took away from it was these studies to suggest how to digest the supply issues here. Yeah. There's something new that's coming through in the property market, and I think people are reacting in a big way on that too.
Yeah, next now would be to how they fund that as well, and how they get rid of the inventory.
Right? Need the numbers behind it.
Absolutely. Yeah. Okay, we'll leave you with that. Positive end to the show, 4% on the HS Tech Index. Plenty more ahead. This is Bloomberg.